In the end, the answer is we're looking to make a margin. So we make a margin on mining and selling iron ore, and we're also looking to make a margin on providing haulage and port services.
Welcome to today's webinar with Fenix Resources. I'm Dannika Warburton. I'm the Investor Relations Representative, and I'm joined today by your Chairman, John Welborn, who is going to be discussing the September quarter results. So without further ado, I'm very pleased to introduce John Welborn.
Thanks very much, Dannika, and thank you to everyone tuning into this webinar and interested in Fenix. Very proud of our quarterly activities report this morning, which demonstrates it's a very busy and exciting time at Fenix Resources. The quarterly was championed by an ongoing cost reduction of our C1 costs from production from Iron Ridge, which have now been reduced to just under 76 Australian dollars per wet metric tonne. We published positive financial reports for the year ended 30 June 2023, and that allowed us to declare and pay during the September quarter a fully franked 2-cent dividend to our shareholders. And along with those very strong operating performances, the quarter was championed by a series of transactions. We acquired Mount Gibson's Midwest iron ore assets and completed that transaction during the quarter, greatly expanding our facilities at Geraldton Port. It provides us 2 rail sidings at Riverdeeny and Perenjori, and also acquired the Shine iron ore mine and added 15 million tonnes to our Midwest iron ore inventory. Part of that transaction was we also acquired some redundant assets of Mount Gibson's at the Extension Hill project, where Mount Gibson had completed their hematite mining activities. And we're very pleased during the quarter to have announced the sale of those assets, which consist of a crusher and various other rights and obligations, including a camp. And they've been acquired by EHPL Limited and Terra Mining for the use with their Extension Hill magnetite project. And that's a logical transaction for Fenix, where we'll gain up to $2 million. And we've also, we're working very closely with Extension Hill Proprietary Limited and with Terra on how we can further support what is another exciting production opportunity in the Midwest. And we ended the quarter with the announcement of a 10 million tonne right to mine with Sinosteel Midwest Corporation on the high-grade Beebyn W11 deposit. And this is a game-changing transaction for Fenix. It's a very high-grade deposit, very similar to Iron Ridge, and only 20 kilometres away from our nameplate flagship project. And that's something that the shareholders are going to hear a lot more of as we work on our plans to bring that into production. So if you add all of those transactions together with the previous consolidation of the Fenix-Newhaul business, we're pulling together the rungs of what is a very exciting growth profile ladder about expanding our business in the Midwest. Focusing on the quarterly activities, it was a quarter where we completed 6 shipments, totaling just over 350,000 tonnes of iron ore, and that was split fairly closely. 45% of that was lump, 166,000 tonnes, and 185,000 tonnes of fines iron ore. We continue to demonstrate remarkable product consistency and very high grades, low impurities. So the lump product is still averaging around 64.5% iron, and the fines product around 63.5%, and that's providing our customers with a very strong, environmentally friendly product that we're getting a premium above the 62% Platts index price. The quarter was also assisted by strength in that iron ore price, and we've remarked that as of today, it's trending back towards US $120 a tonne. So it's a good time to be an iron ore miner. That cash cost reduction of 5% to $75.90 was achieved again from an outstanding performance from our largest cost driver, which is haulage. Iron Ridge is located 500 kilometres from the port of Geraldton, and the largest cost that Fenix incurs is not our mining or our port services or shipping. It's the haulage that we do between Geraldton between Iron Ridge and Geraldton, and the consolidation and ownership of that business is allowing us to deliver industry-leading haulage numbers, and we're getting the benefit of that into C1 cash cost reduction. That, combined with a slight decrease in shipping costs and the strength of the iron ore price that I've indicated, has meant that our net C1 operating margin rose to $70 a tonne. It's a fantastic number. We're a relatively small-scale miner. We're a relatively high-cost miner compared to the much larger iron ore producers in the northwest. However, since inception, we've averaged around $50 a tonne in operating margin, and the September quarter was obviously a very good one, growing that to 70. And you see that directly into our cash. Obviously, we started or ended 30 June 2023 with just more than $75 million in cash, and we ended this quarter with $56 million in cash, and that's due to the payment of just under $14 million, sorry, $59.6 million. So we're just under $60 million at the end of the quarter. And during the quarter, we obviously invested $10 million in the payment to Mount Gibson, and also just under $14 million to our shareholders in the fully franked dividend. And if you add a few other items, it demonstrates that we generated operating cash of $14 million, or almost $5 million a month during the 3-month quarter, which is the sort of numbers that we've consistently done from Iron Ridge since inception. It's been a very strong project, and it's quite exciting for Fenix to now have 2 other similar scale opportunities in our portfolio, being the Cheyenne iron ore mine that we've acquired from Mount Gibson, and now the 10 million tonne right to mine on the neighbouring Beebyn W11 project. And shareholders should be excited as we look to bring those projects into production using our fully integrated logistics train. The other key element for this quarter, and we've highlighted it, is the creation and establishment of the Fenix Port Services business, and where we inherited some short-term transitional arrangements from Mount Gibson, and that's allowed us to move third-party tonnes through the port, starting immediately. That's a business that we're quite excited about, the ability to provide third-party logistics to a range of Midwest producers and potential producers, not just in the iron ore world. Obviously, the Midwest is full of exciting projects in potash, lithium spodumene, garnet, talc, silica sands, and a range of other commodities, all of which in many cases need to find their way to Geraldton and get loaded into boats to reach global customers. And that business is one that we're looking to update shareholders during the current quarter in a number of discussions we're having, both in terms of providing third-party haulage as well as providing third-party port services. So, Dannika, another really strong quarter. We continue to operate Iron Ridge very consistently, high products, 1.3 million tonnes per annum. It's a very strongly cash generative project, and there's a range of other growth initiatives where we're looking to expand our revenue base and ultimately demonstrate that we can be a highly profitable Midwest miner and a highly profitable Midwest logistics provider. Very happy to answer any questions.
Thank you, John. Well, it's certainly been an action-packed quarter, and the overall theme of the commentary has been very positive comments on the cost numbers. So I'm going to pull out a couple of questions that have been sent through on that particular cost question. I've chosen one from Roger. He says, John, I'm very impressed with the cost control. How has it been possible for Fenix to continually reduce C1 cash costs over the last 18 months? And how low do you think you can get them?
Well, that's I'm glad he's noticed that it's not just a 1-quarter performance. If you go back to June of 2022, our C1 cash costs were $91.50 FOB Geraldton. And I think that was a very understandable number compared to the feasibility study that Fenix had published 18 months beforehand, prior to the very rapid and successful implementation and commissioning of the Iron Ridge mine. Since that, over the last 18 months, we've seen record cost inflation. And if you look at any of the other iron ore miners of any scale, but particularly small-scale bulk commodity miners, they've been hit by a number of cost inflation drivers, including fuel costs and particularly labour costs. So it is remarkable that since then, we've taken more than $15 out of our C1 cash cost. And it's been a fairly consistent reduction. I think we got below $80 in the December quarter of 2022. We then had a slight increase in March, but we're back down to just under $80 in the June quarter, and now we're under $76 a tonne. So it's a remarkable cost reduction, and we've indicated quite clearly that that's been driven by largely haulage efficiencies, but it's also across our business. We've have a very small focused team that are looking at how we can deliver a sustainable and increased ongoing cost saving in our product. The biggest number, though, of that 15 has been the more than $10 a tonne that we've saved directly to our bottom line from the consolidation of the Fenix-Newhaul business. And just to explain that, that was a transformational transaction. The original idea to be a joint venture partner in a haulage contractor was a relatively unique decision for Fenix, and the decision to acquire that 50% and operate that business as a wholly owned subsidiary has allowed us to capture the operating margin within that business. And it's also allowed us to focus on the connection between the volumes and consistency of the product we mine at the Iron Ridge mine with the loading of our haul trucks, the rotation, operation and rostering of our haul trucks, and the delivery and management of our port storage systems. And the integration of all of those things and the efficiency of them is what flows through into our cost. Iron ore and bulk commodity mining is always around moving tonnes, and the easiest way to bring down your costs is changing the denominator, as in increasing your volume, and your fixed costs will be spread across more tonnes. In our case, we haven't. We've been very consistent with our volume. So the answer to Roger's questions on costs are we're just spending less money, and we're doing that by a whole range of little things. Improving the efficiency of our fuel use. We reward our drivers. We have an incredible data management system at Fenix-Newhaul. That allows us to monitor a whole range of things and report and supervise our drivers in relation to their use of cruise control, their use of brakes, the speed that they're operating. And we rank the drivers and pay them a bonus based on performance. And since we've implemented that system, we've seen a direct saving of more than $2 million across the business. That's one example. The making sure that we don't have standby time, both at the port in terms of laycan and demurrage, and also drivers waiting for product, and all of the things. The bottom line is efficiency and management. How low can they go, which is the last part of that question. That the next step for us is to add to our volumes, and that's why I mentioned that, because the really exciting thing for Fenix and the reality about getting significantly lower costs will be moving from a 1.3 million tonne a year miner to 2 and then 3, and then I am pleased to say that we're ambitious enough to be targeting 5 million tonnes and beyond, and that would allow us to target much lower costs. We need to do the work on the feasibility studies that will drive that production, and so that the target at Iron Ridge, I think, is, if you look at our feasibility and what we're doing, it's remarkable. So getting the costs down to near $75 a tonne and maintaining them there would be my target and the answer to the question. But the longer term reality is, we are not unaware of long-term iron ore forecasts, which are below the current bullish prices we're seeing. And so we have, what you're seeing in terms of our transactions and our focus is, we have a long-term view that we want to bring our costs down below $50 Australian a tonne. The only way to do that will be a fundamental ongoing transformation of the business. So at Iron Ridge, I think $76 a tonne, which was this quarter, is exceptional. We'll try and wherever we can get more cost savings, but to sustain that will be an excellent effort from a very motivated and efficient team. But longer term, put together the transactions we're doing, and we do see an opportunity, as many people have done over decades, for the Midwest to be a sustainable, long-term and low-cost iron ore producer. And at Fenix, we're looking to lead that.
We'll get there's a lot of questions on the growth pathway that have come through, but you mentioned the current bullish iron ore prices, and I might stick with that for the moment, as Sam has asked, will Fenix look to secure more hedges in January to June 2024?
Yes, we will. We've been very disciplined and opportunistic in our hedging policy. So if shareholders are interested and they're tracking the iron ore price and they're looking at when we've placed hedges, you'll see that we've been efficient in placing hedges at the top end of the curve. And that's allowed us to have a very strong price support mechanism through that hedging. At the moment, we've still got some $170 hedges in place to December, and then we've got 25,000 tonnes hedged all the way out to June and the end of the financial year at around $165 a tonne. You can't get those prices at the moment, so we're not adding to that hedging position. If we see the curve strengthen, particularly as we get closer, it usually does, we'll look to add to that. We like to have around 40 to 50% of our forecast production hedged. And when we can, we'll lock those hedges in. In the meantime, our best price protection is obviously to continue to lower our costs. And in an environment where we're generating a $70 net operating margin, we're obviously demonstrating we've got a very robust business. And part of that is the strength of our price protection.
And so you touched on the fact that this quarter especially has been very significant in terms of the transactions that you've done. Fenix-Newhaul, Mount Gibson's Midwest asset acquisition, the Beebyn, and most recently Beebyn W11. The question from Sue that I'll read out is, in light of those significant transactions, the share price performance seems to have been poor. Can you give us your explanation of why the market has perhaps reacted negatively?
Well, Dannika, I'd ask Sue to buy some shares. The price of your share price is driven by buyers. Many people who run companies blame the sellers of stocks. I think Fenix is a very exciting company, and I think we've demonstrated another strong quarter. I can understand Sue's question, in that I am also surprised by the somewhat somber response in the share price to what I think are transformative transactions. I'm probably, it's like asking about the iron ore price. I'm probably the last person to ask why. However, I think a lot of investors have exposure to iron ore through the majors, and they're used to lower cost, but interestingly, lower margin iron ore prices. It's not a commodity that's attracting strong positive support. In fact, I've already mentioned that the long-term iron ore, almost universally, long-term iron ore price forecasts are at significantly lower levels than current iron ore prices. And it's hard to attract speculative investors to a commodity where the long-term forecast is falling. However, I think that we're going to demonstrate that Iron Ridge will continue to be the profit generator it's been, and we're adding a number of other potential similar scale projects with the Cheyenne iron ore mine, and particularly with the similar grade W11 opportunity, as well as a new business in terms of logistics provision. But seeing though that EBITDA growth is going to drive the reaction in the share price. So we've got a register that's very strongly focused towards retail investors who are very rewarded by dividend streams and we're looking to attract new investors who can see the growth opportunity. So at Fenix, we're going to be patient, and we're going to continue to put together really strong operating performances, and we're confident that that will see growth in revenues, growth in earnings, and that'll ultimately play out in the market cap of the company and therefore the share price.
Okay. And so Fenix has been a 1.5 million tonne per annum miner, and now with the addition of Shine and W11, could you walk us through what your production targets are going to be going forward? You know, do you think that Fenix will be a 5 million tonne per annum producer, or do you plan to sort of mine at the current rate for longer?
I think it's an interesting question to think of, you know, are the extensions of our resource inventory around extending our mine life or increasing production, or both. I've indicated earlier that we see the best way to reduce costs is to increasing our production volumes, and that's certainly a focus. So we, you know, there's an obvious operating consistency around the projects that we've picked up in the Midwest in terms of scale. So we do see potentially Shine and potentially W11 as similar scale operations to Iron Ridge. And so you can see how we could be targeting a 5 million tonne a year producer, which would make Fenix a significant iron ore company. How we put that together, we're working on the feasibility studies and implementation plans and the capital requirements of doing that. I think so that's the answer. We haven't yet published our projections or our plans on when and how we're going to bring other opportunities in production. We've obviously got a great track record with doing so on budget, on time at Iron Ridge, and that'll be our focus in anything else we do. But the other business dimension is our logistics business, which is obviously also a long-term view and a very sustainable potential revenue and profit generator for Fenix. So the shorter answer is both. We want to obviously be a long-term and sustainable operator in the Midwest, both as a miner and a logistics provider, and we want to be a larger scale operator. So we're looking to extend the existing production mine lives, but also grow volumes. Okay. And in terms of the exact quantities and timing and capital requirements on that, I'd ask shareholders to stay tuned while we put together that work, and we'll be publishing those plans as soon as they're in place.
Okay, because that was actually going to be my next question from Michael, who's asked about Beeb and W11 and what the plan is to bring it into production and how profitable you think it will be for Fenix.
Well, I think the obvious analogy for Beeb and W11 is Iron Ridge. They're very similar scale ore bodies. They look to be a very similar mine operation. So if you look back at the capital cost of Fenix's Iron Ridge development and the cash that we've generated, that would be the obvious blueprint that we'll be following for Beeb and W11. And just to remind people, Fenix raised $15 million in 2020 and successfully commissioned Iron Ridge on the back of that capital raising. And we've since delivered more than $150 million of operating cash flow from the mine. So it's a great legacy and an ongoing operation, and the obvious guide for us and for the market on Beeb and W11 is to replicate that, and that's why we're so excited by being able to announce this 10 million tonne right to mine.
Okay, and something we haven't touched on is your decision to sell the Extension Hill project. Based on what you've said about increasing production, did you consider further production from Extension Hill at all?
So of the asset package we picked up from Mount Gibson, Mount Gibson have been the largest scale iron ore miner in the Midwest. They've mined and produced more than 50 million tonnes from Talon Peak and Extension Hill. The Extension Hill magnetite project was not owned by Mount Gibson, and we didn't acquire that. So what we acquired was the assets that were related to their completed hematite mining activities. So we didn't really have an option to continue activities at Extension Hill. There was no resources there to mine. So what we acquired was a crusher on care and maintenance and a large mining camp. And the related rehabilitation obligations and licenses. So selling those assets, which were really a cost centre for both Mount Gibson and ourselves, which is a logical transaction. I think doing so in a way that's been value creative for Fenix is positive, but it's also part of a partnership with the owners of the Extension Hill magnetite project, because the assets are incredibly useful for them, and we'll be working with them on how else we can support their project. So it wasn't an option for us to look at production from Extension Hill, but we do see some opportunities to partner with them on their exciting project in terms of haulage, potentially rail access, and certainly port services.
Okay. And a question that's come through, your focus seems to be on the acquisitions that you've currently made, but are there plans to update shareholders on your exploration assets?
The Midwest is an interesting place. There's been a lot of exploration, and I think if you look at our recent corporate presentations, there's a slide where we put a dot on the map on all the projects that are currently where there's known reserves or projects in feasibility study stage across a whole range of commodities. So the exploration isn't a focus of Fenix. We think there are, what we've done is monetize a known ore body at Iron Ridge. And if you look at what we're doing, we've acquired a known ore body at Shine, and we've acquired the right to mine a similar ore body to Iron Ridge next door to us at Beebyn W11. There are a number of other opportunities in the Midwest. So there's been huge investment in defining resources and completing feasibility studies. Our opportunity at Fenix, given the logistics solutions we have both in haulage, rail access and port, is to monetize those, and not just in iron ore and a whole range of other commodities. So I think it's a positive that we're not reliant on sending out intrepid exploration geologists to scour the earth and drill at great cost to try and find scarce resources. We think we can monetize the resources that are already there. So, and I think we're demonstrating that.
Okay, and how should we think about the Fenix Port Services business? We've had a couple of questions that come through on, how can you make money from just doing the haulage and the ports businesses, or if you can, and specifically the questions are around what size haulage contracts that Fenix-Newhaul is targeting, and what size port contracts is Fenix Port Services targeting.
I'd say stay tuned, because we're looking forward to being able to demonstrate how that business works. But if you go back to the baseline feasibility study for Iron Ridge, we had mining costs at $20 to $25 a tonne, haulage costs at $50 a tonne, and I think our projection of what our port costs would be with $15 a tonne. So anyone who follows Midwest iron ore miners would know that the largest costs are not mining, they're logistics, and particularly haulage or rail costs of getting products to the port and then storing that material at the port and ship loading. And so, the largest cost components are in that haulage and port services space. And so being able to be a solution provider, and we have a remarkable capacity for on-wharf storage, and we've also, I think, got an industry-leading haulage capacity. Both of those can potentially be high-margin business. And in this, the way to think about it is to look at the way we've reported this quarter. We produced 350,000 tonnes ourselves and shipped that through the port, but we also produced we also handled more than 150,000 tonnes of third-party product through the port. We will be able to generate a margin from the charges we're making, and we'll be able to demonstrate that when we've locked in longer term customers. What we're looking for is consistent, reliable producers like Fenix. So we want producers of scale and producers who've got consistency, because that's how you actually operate a efficient logistics train. So we're looking for bulk commodity producers in the Midwest who are looking to do more than 1 million tonnes a year of product, and it can be any commodity. And we're working with the Midwest Port Authority on how we can expand the operations of the port and help them achieve their very ambitious targets of increasing exports from Geraldton well beyond 20 million tonnes a year. And I think Fenix can be a big part of that. In the end, the answer is we're looking to make a margin. So we make a margin on mining and selling iron ore, and we're also looking to make a margin on providing haulage and port services.
Okay, so on the ambition point, you've told us that your ambition is to be a major regional iron ore producer, but also to be a profitable third-party logistics provider. Which one's more important in your mind?
Look, I think they go together. So any iron ore miner is reliant on logistics. And if you look at the big iron ore miners, the really successful ones are ones like Fenix that have a strong ownership element of the key deliverables, delivery mechanisms of their product, whether it's ownership of railways or ownership of port assets. So Fenix as a small-scale producer is relatively unique in that we own and operate a mine, but we also own and operate our own haulage solution, and we own and operate our own port services. And we want to continue to be a profitable, sustainable and responsible miner. And there's huge opportunities in the Midwest with these high quality resources that need to be monetized or can be monetized. And that's a great opportunity and one that we're looking to exploit. But so hand in hand with that is as an iron ore miner, you are also a logistics provider. And given the Midwest and the vast array of projects in places which not only not currently owned by Fenix, but are unlikely ever to be owned by Fenix, there's a separate opportunity that goes together with that, where we can provide those solutions to other parties. So I think they're logical and they're linked. They are different. Another way to think about that is that we're also going to benefit from diversifications. We think there's ongoing high profit to be made from iron ore mining. But there's no doubt there's also a lot of interest in the lithium potential of the Midwest, the potash potential out of Geraldton, and a range of other commodities, particularly including silica sands and battery metal focused commodities, and all of which providing logistics for those emerging miners would provide a diversification of revenue lines and greater profitability. So I think we've got operating teams in mining and in haulage and in port. We want to expand all of those activities, our own mining activities, but also independently our haulage and our port services activities. And we're working on a number of really exciting opportunities. You're seeing a lot of activity from Fenix. We're doing that while maintaining the stability and consistency of our iron ore production. And I'm really pleased and looking forward to continue to do that.
Yeah, I know that that you could talk forever, John, as you're very passionate about the subject. And but I do want to respect everybody's time and keep this short. There's just one more question that's been sent through from Janano. I hope I'm pronouncing that right. So thank you. With regard to the rail sidings, is there a plan in place to start utilising the rail assets that you bought as part of that logistics business that you discussed?
I absolutely. They are very significant regional assets. The access to railway is a very important part of increasing the tonnage that gets delivered. There is a realistic limit to how much material you can move on the road. And we're looking to continue to be a very efficient user of long-haul haulage by road. But we also see an opportunity to expand production by using rail access. And it was something that Mount Gibson championed with the production I mentioned earlier from Tallarat Peak and Extension Hill. And so, from the north at Riverdini and from the east and the south through Perenjori, we're looking at a number of opportunities which would allow us to increase road traffic tonnages by access to rail. And so stay tuned on that. We think it's a very important part of the Midwest's opportunity to expand production.
Yeah, well, I guess as an investor myself, I think it's been really great to see the growth pathway set out, and perhaps, you know, with these recent transactions, there's a limited understanding of the value of these opportunities, and it's going to be really, really exciting over the next quarter and into 2024 to see you deliver on realizing the value of those. So thank you to everyone.
Thanks, Dan. I've been doing a bit of travel recently, and I watched the Steve Jobs film, and there's obviously that famous presentation he gave about the 3 products he was launching, and you know that he was there to launch a new telephone and a high quality web browser and a new music device, and many people who have seen either live or the film's version of that presentation, and obviously the revelation there's actually one product that you know, which was the iPhone. It's actually the BlackBerry film that replaced that. But I was thinking about that from a Fenix perspective, and if you put together the haulage business and then the Mount Gibson port assets we've acquired, and then the Shine and the Beebyn iron ore mine, you could almost do a Steve Jobs version of it. It's about the haulage, it's about the port, it's about the iron ore. It's actually, you know, 3 things coming to one, which is perhaps a better answer to your question about, well, how should we think about Fenix? I think there is a logic around that M&A activity. We've expanded our haulage capacity first. We own that. We now own a significant position of the port, and now we've got to look at where we're going to monetize assets. So it is exciting, and stay tuned.
Absolutely. Thank you to everyone who joined today's webinar. If you do have any further questions, please feel free to email us as always, and we will get back to you. And we'll also send you the replay of today's webinar, so you can go back through and have a bit of a look. And if there's anything occurring from that you would like to discuss, just reach out. So we'll leave it there. Thanks again. Thanks, John.
Thanks, Dannika.